So I guess it's out of the question to try to cut a deal for a new branch, which used to be the big thing when I was many years ago. That concludes the formal part. This is the fun part now. We get to hammer these guys. We get to ask them questions. And you know, I have a question to start off with. And again, send your questions forward. Write them on a sheet of paper. Colleen, do we have a mic also?
Yeah, we do. We have two.
Okay. Gaylon, we got all these new banking regulations. They're going to make it safe. I mean, everything is being regulated. So are we actually safer now?
You asking me?
I'm asking you. I'm not an expert. You're the expert.
Well, there's a lot of debate about that. There is, you know, like all difficult concepts, there are people on both sides of the equation. I think that an awful lot of people would say that the DoddFrank Bill, which is this thing that got passed, you know, in the midst of the downturn, it's 3,000 pages long and 300 different separate regulations, which they don't seem to be able to get written. But they expect to hold everybody accountable to what you don't know. It's interesting. That really did not fix what you're talking about, which is too big to fail. And which are, you know, very large banks and the risk of systemic meltdown because they fail. Some of the regulators would disagree. I think it's arguably plausible to say that we didn't fix that. And as it relates to all the other regulation that's in all these things that we're dealing with, my experience of 40 years around the banking world tells me that the financial services industry, whether it's investment bankers or commercial bankers, are going to create and innovate faster than the regulators can ever keep up. And so my suggestion is we're not safe.
With all those regulations, can I have a relationship with you as a banker?
Absolutely. I mean, I think, you know, and I would say that about whether you're a big bank or a small bank. I mean, for sure. It manifests itself in different ways, but yeah, absolutely.
Good. I do have some questions that were submitted during the course of the presentation. Again, please pass your questions forward. One is to Lawrence Gray. Have you thought about structuring your company ownership in the form of a REIT format?
At this point, we have not, primarily because there wouldn't be any real benefit to the existing owners as a private REIT. The issue, I don't know if the question is, would you go public as a REIT?
Private REIT.
And if it's, as a public REIT, we're just too small. I think, you know, the REITs have all grown, and liquidity is an important component in valuation. And if you have no liquidity, you're not going to get a very good multiple on your stock. If you don't have a good multiple on your stock, there's no real benefit of, I mean, if you can create liquidity, that's a benefit, but I think rather than becoming a REIT ourselves, if we wanted to get liquidity, we'd sell to a REIT and take back OP units and have a tax-deferred currency as part of the transaction.
Okay. And you have some, I mean, I'm thinking in a family structure that's gone on, you said 100 years plus. How do you decide how to compensate those that are doing the work and those that aren't doing the work and still be fair in their ownership interest?
Well, we've got, I mean, while I am a family member, I am sort of, as it relates to the new iteration of GrayCo, I'm the exception to the rule. Our rule was no family members on the management team. Okay. As our former CEO was retiring and I was coming out of banking, I went to the board and discussed the alternative of going to work there. And yeah, I think the fact our company had grown so dramatically, the issues that we were encountering were very similar to the issues that I dealt with as a banker for many, many years with the clients that we had worked with. You know, we felt that it was a good move to put me in that spot, but I'd say it was much more because of my, I'd ask you to ask the other members of the Gray family here, but I'd say it was a lot more about my my background and experience base than it was being a family member. And so the compensation discussion with me and my management team is the same that we have with our board is, it would be if we had a non-family member in the CEO spot. The board compensates me, I present to them what we ought to pay our people, and they approve it on the compensation committee of the board of directors.
So notwithstanding the fact that it's a closed organization, you're really applying some large company.
Yeah, I mean, when you think about the size of our company, it really is. We've got almost 95 owners, and there's no sort of patriarch that comes in and says, all right, that's great, your management team wants to do this, but this is really what we're going to do. It really is a more traditional corporate style management board relationship.
Here's a question that I have that someone submitted. Michael, how did your timber and your lumber recommendations, asset category, compare with regard to all the other assets that you're putting people into as far as the diversity is concerned?
Well, yeah, timber is part of a real assets allocation, so it's going to be included with some other groups. And in general, our timber investments have been in public REITs, like Plum Creek that was mentioned earlier. It has tended over the years to be not very highly correlated with U.S. equity markets or with the fixed income markets. That correlations have narrowed a little bit in more recent years, and the REITs have done, and overall, as I pointed out in the slide, very well in the past 3.5 years. But in particular, over the past 12 months, the timber REITs have done well. A lot of the larger institutions, those on the endowment model, the so-called Yale model, and so on, they're pretty heavily invested on a relative basis in timber, and I think that's definitely been to their benefit, and it's been a pretty efficient asset class as well for them. You have to have a lot of patience in that asset class or that subsector, or whatever you want to call it. So, but I think it's done really well. We would, certainly love to invest more money in timber, but certainly in the timber REIT space, it's a little bit pricey right now. Not a little bit; it's a lot pricey.
Keep sending your questions in. It looks like we have some more. I have one here for Will. It a little bit parallels the one that I had. Thank you, Colleen. Fauquier County has been attempting to dictate the terms to farms with conservation easements, what they can plan, what they can sell on it, what they produce from their farms, even with respect to wineries. What can you do and not do when you have these things, and how much risk do you have in the ongoing reinterpretation if you have a conservation easement, as far as things you can do and ultimately they may change?
Right. Well, I think that the basic terms of what you can and can't do with respect to the easement will be spelled out in your easement document itself, and that's an instrument that starts as a form but can be negotiated with whoever the receiving party is, if it's the Virginia Outdoors Foundation or a land trust or what. And in there are the basics of what you can and can't do, and those would include restrictions on specific uses and subdivisions and whatnot. I think that's going to be independent of what a locality is going to impose on your property. Maybe it's through the zoning ordinance. I'm not familiar with what Fauquier County is doing. But that just means there's an extra layer of restrictions on your property that you'll need to manage. So when you're considering a conservation easement, it would be important to identify what the restrictions are at the county level, as well as what you'd be agreeing to on a more private basis with the land trust that would be receiving the easement. In my experience, there are certain things within that easement document that can be negotiated. There's some room for flexibility depending on what the primary interest of the group that's receiving the easement may be. For instance, if you have already a farmhouse and you are interested in having your cousin build a farmhouse down the road from you, it's still on your property, there may be some room to subdivide that part of the parcel out as under the terms of the easement. But I think to answer the question, it's imperative to look at both sets of rules before making a decision.
I think there are a lot of people that are hesitant to take advantage of it because of those types of issues, because if you do make a mistake, it's going to be
permanent.
interesting, the first person that tries to undo it. You know, you may have to go to Jimmy Massey and go to the state and try to get it overturned. I mean, Jimmy, you probably know that. Our state delegate. We have a question. We have a mic here. I understand there's a question. Oh, it is Jimmy. There we go.
I got a booming enough voice.
Yes, you do. Yes, you do.
Gaylon, back to the safety of the financial services industry, and specifically as it relates to those 5, I think, or 6 large banks that are too big to fail. I think you said control 75%. One of the things that concerns me is I'm not quite sure they're telling us the truth about the values of the assets on their balance sheet. And in a highly leveraged industry where the capital ratios, you're better, I think in the 10% neck of the woods, plus or minus a couple of percent, that can be a real problem. So my question for you is, if you and I really went in there and marked those balance sheets to market, where we could trade those assets, where do you think that leaves those 2 big banks to fail in terms of their capital ratios?
Well, I mean, I think the crux of the question, sort of the answer, and to your point, is very hard to determine. I mean, we just sort of don't know now. That said, first of all, there are 19 banks that really sort of fall into that too big to fail category. When I said 5 or 6, that's who typically in any one market controls 75% in that market. So there are 19 banks. You know, the regulators have gone through all kinds of stress tests and so forth. They've pronounced them safe. I think within the 19, they're getting into the weeds, there are some really big differences among those institutions. I mean, back to CT's institution. I mean, that's really a very large, what we used to know as regional bank, right? And I mean, fundamentally, they kind of do basic banking. Contrast that, if you will, with JP Morgan, you know, and we all read a newspaper about the whale in London and one thing and another and so forth. I think when you get to that handful of banks, trying to make the determination that you're talking about for, even if you and I went and looked, we wouldn't be able to figure it out. And I worry a little bit, to be frank, that can't anybody figure it out? The regulators, management, or you or I. And so then that is the reason that you hear some conversation around whether or not those very, very large institutions, there ought to be some consideration to splitting them up into separate entities. So, I mean, you know, it's a problem. It goes in the category, a lot of these others we were talking about, these macro problems. It's a macro problem, and my suspicion is it ain't going to get solved anytime soon.
The one thing in the U.S. banking industry is that it's, I mean, it's a lot more transparent than a lot of other places in the world. I mean, a big problem with that is hard to value is the value of really esoteric things like the credit default swaps, and there's really no central clearing house to trade the CDSs, so that's a real problem. But what concerns me is not so much not so much the U.S. banks, because I mean the amount of the amount of liquidity that the U.S. banks are sitting on right now is pretty incredible. I worry more about some of the banks, globally, particularly in certain parts of Europe, like the Spanish banking system. I think is basically insolvent. Although the good news has probably been insolvent for 5 years and hasn't drugged down the whole world yet. But if you can call that good news, but we do have a significant, except for like in CDSs, I think there's significantly more transparency, and hopefully the regulators have been able to use that transparencies with the stress tests better than in some other parts of the world.
I might just jump in here, and I might get Gaylon to weigh in on this, but as I think about having been a banker for a long time as well, the mark-to-market issue is a very real issue, but remember, banks aren't typically putting assets on the books to sell, they're putting assets on the books to maturity. And in this case,
in the latest downturn compared to the early 90s, when I was saying we benefited tremendously from what I think was a very bad public policy that forced banks like Xenith to blow out of these real estate loans because you mark them to market, and all of a sudden, gosh, your capital ratios are really bad. You got to sell them, and you sell assets to guys like us that are buying it for 25 cents on the dollar. There was this massive transfer of wealth from taxpayers to private industry, and again, we're really glad it happened. But if you look at where we are today and how the regulators handled the banking industry in 2009, 2010, the economy has recovered, values have come back, rents have improved, loan to values have improved, and there wasn't this massive transfer of wealth from taxpayers to private industry. So I don't know if the regulations are keeping us safer, but I do think that public policy was a lot smarter in this downturn than in the past. I don't know if you would agree with that or disagree.
Well, very complicated. I don't know that I would agree with that. This downturn, there's a guy who ran the FDIC during the last downturn, whose name was Bill Isaacs, and he's actually written a book about how poorly it's been handled this go around versus last time, and while you're right, I mean we've recovered. I mean we eventually recovered last time as well, right? But coming out of this one, it's still sluggish. I think the sense is that last time, while it was painful for the banks and we marked everything down and we sold it and we got it off the balance sheet, we got to equilibrium more quickly than we have this time. And this time we have just kicked the can down the road, and the fear is that there's another shoe to drop, that we just really haven't cleared the markets yet.
So there's more of an overhang that's just chronically out there because there hasn't been a market clearing transaction.
Right. Or maybe it's cleared by now, but had we cleared it 2.5 years ago, we would have had a more robust economic recovery today than we've been able to orchestrate. That's the argument.
Here's another question that somebody submitted. It's actually close to my heart, and that is the amount of money that's being issued by the Fed, the increase of our deficit, the balance sheet of the Fed. And I got to tell you personally, and the question here too is, how come we don't have inflation? And what would it take to trigger inflation? And if it did get triggered, how much of a window will we have? And you know, personally, I don't know about the rest of you, I thought we'd have inflation by now, and I've been totally wrong. You just, one stands to reason, and I always get confused why what's going to trigger that, or you may say it's not going to. We're going to be like Japan. It just will stay low rates. This is a free-for-all. Go for it.
I can't answer the question.
But I want you to.
No, I know you do. A lot of things you want, you don't get.
He's a banker.
Yeah, right, exactly. It's interesting. A few weeks ago, VCU, I don't know whether anybody, Lawrence, I might have seen you there. VCU sponsored a really well-done seminar. They had Jeff Lacker, who's president of the Richmond Fed, and the guy who's president of Chicago Fed, I think it was, come and talk about just this question. What's the Fed doing, all this monetary policy, by, QE 47.5 or whatever it is, and what's going on? So you got these two absolutely brilliant men standing up there who clearly respect each other really in a really very nice sort of friendly way, and they look at the same set of facts and come to two completely different conclusions. So how the heck do you think any of us are going to figure it out?
You're at Darden School, you went to collegiate, how do we defend then? I mean, if it is it's a real risk.
It is a risk.
So the issue, I'm assuming there'll be issues of leverage, how you diversify. I mean, are these the same old strategies we've had, or is there different strategies today with the types of risk that we're facing, the types of headwinds? Because I've been through ups and downs in my career, and maybe it's because I'm old, but just seems to be different than the previous ones. One little aside, I remember in 1990, we hit the big savings and loan debacle. And we had sales at Innsbruck, we had huge prices. It came to a screeching halt, nothing happened. And we made an investment decision, but that was only the benefit of low leverage. And that was, we said the very best investment we could make was to sell nothing. People say, well, you got to sell at 25 cents on the dollar. I said, no, we don't. We'll just sit here because that's now become our new asset class, sitting on our own distressed real estate. But how do you, that's a new category. Yeah, that's it. So anyway, how do you manage that today, and is it different from the past? That's the question I have here.
You're talking about in a macro sense.
Yeah, well, I mean, that's where...
Well, Mike's probably better equipped to answer that than I am. I think it is different. I mean, I think we have never before faced a time when there are as many macro issues that simply, this is a personal opinion, just simply are not being dealt with. And most of them are in Washington, right? And those risks, I think, do magnify the likelihood of that wide set of outcomes that Lawrence was talking about, and you don't know. So I think there's a degree of uncertainty that I think as business people we need to take into account that we've never faced before.
Lawrence is loading up on apartments. I mean,
We are, and I guess when we think about risk, we think about the asset class that we're in, as well as the leverage points at which we operate it. And we spent a lot of time at our board doing scenario planning, what happens if this goes wrong or that goes wrong. And we were in a board meeting and having this discussion, and we did say, well, look, let's just go back to 2009. A lot of things went wrong. How did our investment strategy and our leverage strategy hold up in that environment? And I think you and I were talking earlier, Sidney, leverage is really important. We went into that downturn at about 55% leverage in our apartment portfolio. On a piece of paper, we went up to 80% when we marked, we didn't take losses, but on a mark to market, we said, gosh, we're at 80% leverage. Now, we were more conservative than the lenders because we had 4 or 5 loans mature during that period of time, and we were able to not only refinance, but actually get some money back out when we did it in 2009 and 2010. So if we had been levered at 75% going into that downturn, as many of you guys know, real estate guys don't go broke because they can't service their debt. They go broke because they can't refi. And we were able to do that because we had a modest leverage policy, and we're going to stick with it.
Or you owe so much money they have to.
We try not to do that one, yeah.
Thank you very much. That concludes the formal part, but before we adjourn, if you'd like to get a copy of the day's presentation, drop your business card or contact information in the bowl at the table next to the door on the registration table out front, and help yourself to the parting gifts back here on the table between the doors and the ballroom. And probably one of the best things to help us in our future decision-making in this confusing world, and I think I probably have the best advice of this whole group here, is right now we're going to have a cocktail hour, we're going to have a drink, and then the truth will come out. Thank you very much. We really appreciate everybody pretending.